Welcome to the 7th episode of Investing Sense. I hope you have watched my last video, Right Time to Invest in Banking Stocks. This video is a continuation of the previous video. In this video, I will mainly delve into discussions regarding small finance banks. I had the below questions in my mind when I started my research on banking sector. Obviously, the first question will be, what is small finance bank and why should I invest in it? Why should I invest in a small finance bank? When banking sector itself is very competitive and small finance bank represents a small chunk of that. In banking sector, there are 12 public sector banks, 21 private sector banks, there are regional rural banks, cooperative banks, foreign banks, etc. So why should I choose a small finance bank out of all these banks? When big established banks like HDFC Bank, ICICI Bank, etc. are already available at great valuations, why should I go behind the small finance banks? Let us try to find out an answer for the above questions in this video. I request you to watch the video till the end. I am sharing one arbitrage opportunity available towards the end of the video which you can utilize for making money. First, let us go to the basics. What is the small finance bank? Where do value lie in investing in them? The behemoths among private banks like HDFC Bank or ICICI Bank mainly target the rich people for building their businesses. Most private banks require a minimum balance in thousands to be kept for opening a savings bank account. For a lot of people, these thousands are a big sum and is not affordable. Where do such people go for meeting their banking needs? Small finance bank emerged as a solution for this problem to provide financial inclusion for the sections of society not being served by existing banks. These banks will give very small amount, say 10,000 rupees, etc. as loan for small period, say 6 months, etc. They give unsecured loans also. This is the business done by money lenders in villages. So in a way, small finance banks are grabbing the business of money lenders. Small finance banks also charge very high interest rates around 20 to 25% for unsecured loans. But this is a better option for customers than the exorbitant rate charged by money lenders. So this is a win-win situation for both customers and banks. For customers, they can access formal credit facilities for meeting their needs and can also use it wisely to increase their life situation. For example, these small loans will help a dairy farmer to purchase another cow or for him to purchase a milking machine, both of which will help the poor farmer to increase his productivity and indirectly open more earning avenue for him. So it is beneficial for poor people and rates are cheaper than the local money lender. It is advantageous for small finance banks because they can charge higher interest rate and remain profitable to combat the additional risk they are taking. That is why I said it is a win-win situation for both customers and small finance banks. And there is no restriction on these banks to any geography. They can open their branches in urban as well as rural areas. If you see these banks, they are mobilizing funds mainly from metros and urban areas. I will give you a data point to justify it. For Ujjivan Small Finance Bank, 82% of the deposits are coming from metro and urban and only 2% is sourced from rural. 66% of the loans are sourced from urban and metro and only 7% of loans for Ujjivan Small Finance Bank is coming from rural areas. Isn't it actually an advantage that small finance banks are sourcing money from the potential customers of HDFC and ICICI and giving this money back to customers whom HDFC or ICICI can't cater at a much higher interest rates? Of course, they have to give a high return for these deposit. Most of these banks offer 7 to 8% on savings account, but they are charging even higher rates on loans. That is why you can see the net interest margin of many of these banks are almost double that of normal banks. So you may be wondering why there is no restrictions for small finance banks. Why then these small finance banks are considered as a special category of banks by RBI? Of course, there are many restrictions in business, friend. For example, this small finance bank have to give 75% of their net credit to priority sector, whereas commercial banks need to give only 40%. As per the RBI circular released in 2016, there are 8 broad categories of priority sector lending. They are agriculture, micro, small and medium enterprises, export credit, education, housing, social infrastructure, renewable energy and others. And small finance bank have to give 75% of the loans to these categories. Plus 50% of the loans in the portfolio of small finance bank should be less than 25 lakh range. So these are the restrictions specified by RBI for small finance bank. So let me answer the question I have raised initially. Even though banking space is very competitive with hundreds of banks, these small finance banks are focusing on a relatively niche sector where they are focusing on low ticket size and for small time periods. Big private banks like ICICI or HDFC are not competitors to them but are complementary to them. This is the reason why most of the small finance banks are having good double-digit growth and high profitability. You may be thinking that banks like HDFC are also currently focusing heavily on rural branch expansion. Yes, it is true, but they are only interested in the top layer of the people in the rural areas. Most of the small finance banks were incorporated in 2016 and 17. Within 8 to 9 years of operation, they have survived very difficult situations like demonetization, COVID, etc. And they are still maintaining good asset quality. As these banks give mostly unsecured loans, these banks will be heavily affected during any type of crisis, say cyclone, drought, etc., as they are giving loans to poor people and they may not be able to repay it in these extreme situations. But when economy is going through a good run, they will get benefited because of their higher margins. So this business qualifies somewhat as a cyclical business. I hope you got clarified about the potential of small finance banks. Now I will come to the most difficult part of it. Which bank to choose among the 6 listed small finance banks? Almost all the 6 banks look equally attractive. It is extremely difficult to pinpoint one bank. I have questions in my mind. Should I find a bank which will race against other banks and emerge as a winner like what HDFC has done after 90s? Or can I find a bank which is now available as a great investment opportunity so that I will get a good return for the money I have invested? My approach is to mix both the questions to find a bank that can be a good investment opportunity and at the same time doing things better than the competitors so that they will have potential to emerge as winners in future. So let us look into the figures. First one, valuation. Price to book value is compared for banks and not price to earning ratio. Banks do business with book value and book value is assets of the bank, that is loan issued to the customer, minus liabilities, and bank do business with this book value. Earning may vary depend on the provisions kept for meeting the NPA requirement. Hence price to earning ratio is not used but price to book value is used for comparing banks. So we will check how the 6 listed banks are comparing among price to book ratio. AU Small Finance Bank is showing as slightly expensive in price to book ratio and an outlier in these ratios. Profitability. Next, I will add return on asset and equity, which are indicators of bank profitability. Low return on asset means that the bank is not able to use its assets efficiently. Return on asset is net income divided by total assets. AU Small Finance Bank has the lowest return on asset, again an outlier. Ujjivan Small Finance Bank is having the highest return on assets. Return on equity reveals how effectively a corporation is generating profit from the money that investors have put into the business. Return on equity is net income divided by total shareholders' equity. Suryodaya Small Finance Bank has the lowest return on equity, followed by AU Small Finance Bank, which is again in the negative list. Ujjivan Small Finance Bank is having the highest return on asset. Next, we are comparing cost of funds as well as net interest margin. Banks' funds are raised from savings account, which customers keeps, and the interest bank have to provide for deposit of the customers is its cost of funds. The lower the cost of funds, the better the returns. Here, AU is having the lowest cost of funds, but there is a problem when we look at their net interest margin. Net interest margin is the net return on banks' earning asset, which include investment securities, loans, and leases. It is the ratio of net interest income minus net interest expense divided by earning assets. A higher net interest margin is preferred. Even though AU Small Finance Bank is having low cost of funds, they couldn't use it to their advantage, resulting in lowest net interest margin. Here I will add one more narrative. Around 1/3 of the credits of AU Small Finance Bank is in the vehicle finance segment, which is secured loans. So AU Small Finance Bank has higher investment in secured loan category compared to its other small finance bank peers. Interest rate is less for secured loans compared to unsecured. Risk is also less. Hence, AU Small Finance Bank is the one with the smallest net interest margin. My take on this scenario is I am planning to invest in small finance bank, leaving established banks because my risk appetite is more. So I am not concerned with the share of unsecured loan because in the first place I decided to invest in small finance bank, seeing the higher margins and the ability to charge higher interest rate to the customers. So AU Small Finance Bank doesn't seem to be as attractive, and I could easily pick a more safer large bank over AU Small Finance Bank. So I am dropping AU Small Finance Bank because of high price to book ratio and low return on asset, low return on equity and low net interest margin. Third parameter we are comparing is asset quality. We will move with the next set of 5 banks and see how they fare in asset quality metrics. Capital adequacy ratio. Capital adequacy ratio ensures that the bank have adequate financial cushion to absorb any reasonable amount of losses before they become insolvent. Higher capital adequacy ratio is better. Equitas and ISAF are having low capital adequacy ratio in this list. ISAF had been one of the best performer in most of the parameters till now, like price to book ratio, return on equity, net interest margin, etc. It is sad to see this bank in the red list now. Let us look NPA performance. NPA or non-performing asset means loans or advances issued by banks and the borrower have failed to make the payment on principal and interest for at least 90 days. It is important for banks to keep track of their non-performing asset because too many NPAs will affect their liquidity and growth abilities. Two types of NPAs are there, net NPA and gross NPA. Net NPA is considered for our analysis because it reflects the actual loss suffered by the bank. Here, Suryodaya and ISAF are faring very bad in net NPA. It is quite a concern and gives a feeling that they were giving loans without profiling customers correctly. Suryodaya Small Finance Bank is having presence only in 15 states and union territories. So its distribution reach is less compared to its peers. Maybe this is the reason why the asset and deposit held by Suryodaya is very low. Return on asset and return on equity for Suryodaya is among the lowest in this list. There is one more parameter for operational efficiency of bank, that is cost to income, which is 65% for Suryodaya and highest among these banks. A low cost to income shows better operational efficiency. So after making all these considerations into account, I am dropping Suryodaya Bank from our analysis. Next is ESAF Bank. ESAF is also having very high net NPA. ESAF is recently listed bank. What is more concerning is a news article I have read few days ago stating that RBI has imposed a penalty of 29.55 lakh rupees on ESAF, Small Finance Bank, for non-compliance with its directions on customer service in banks. I am not very comfortable when I hear such news. I am dropping ESAF on my doubt whether ESAF is lagging in compliance angle. Now the competition became lot tougher with 3 participants. So I have added more parameters. In distribution reach, Equitas is lagging behind with presence only in 18 states and union territories, even though they have 956 banking outlets. Next, we compare assets and deposits under management. Ujjivan and Equitas are managing almost same size of assets and liabilities, but Ujjivan is able to generate more profit from its assets. So profit after tax for Ujjivan is higher. 3. Cost to income ratio. Cost to income essentially compares the operating cost of a bank to its operating income. A lower cost to income ratio implies higher operational efficiency, which is an ideal scenario for banks. Cost to income of Equitas is very high and definitely an outlier. So isn't there enough reasons for shorting Equitas? But Equitas is a relatively safe bet with around one-fourth of the advances in the vehicle finance, which is a secured loan portfolio. You can invest in this bank, but I have one specific reason for not selecting this bank. I have read Q2 con call and I have got a feeling that they are not taking branch expansion seriously. In the screen, you can see excerpts from their con call. This is a statement I didn't quite like. Many Indian banks are adding branches at the fastest pace in several years to get more deposits. People think that with growing familiarity with digital transaction, there is no need for physical branches. But it is not true. A study conducted by Accenture for 2000 people showed that 78% of the people preferred physical branches for solution to the issues they are facing. Branch banking is the fulcrum of customer relationship. So having a physical branch is extremely important. So after dropping Equitas, it is a tough competition between Utkarsh and Ujjivan. Reading through their con call, it seems that strategies are almost similar. Both banks are focusing to expand more into non-metros, semi-urban and rural. Both are investing in technology for having digital experience for their customers. I am preferring Ujjivan over Utkarsh. I am listing some points I found interesting and important about both the banks. Ujjivan has a more well-diversified presence than Utkarsh. Utkarsh is having geographical and product concentration of loan portfolio. Out of Utkarsh Bank's 830 banking outlet as on March 31, 2023, 522 are located in rural and semi-urban areas. Bihar and UP constitute around 57% of loan portfolio of Utkarsh Bank. Even though Ujjivan Bank is having the highest representation in South, its total gross loan book is well diversified with 30% in South, 26% each in North and East, 17% in West. Secondly, in most of the parameters, Ujjivan is slightly ahead of Utkarsh. Ujjivan has lower net NPA, higher capital adequacy ratio. Ujjivan has better return on asset, better return on equity, lower cost to income than Utkarsh. So Ujjivan is slightly ahead than Utkarsh. I have taken only Q2 figures for my analysis. Both the banks' product portfolio looked almost similar. Both are focusing on home loans, vehicle loans, loan against properties, etc. Ujjivan is focusing more to get individual loans from existing group loan buyers. Ujjivan management is slightly more experienced than Utkarsh. Most of them have graduated from top-notch colleges and have huge experience by working in foreign banks. Shareholding pattern of both Utkarsh and Ujjivan are almost similar. Around 18% of the shares are held by public in both the banks. Both the banks are focusing excessively on technology and digital. They are ahead of their industry in bringing lot of efficiencies. Ujjivan has spelled out well-defined goals in various sectors. They want to position themselves as a mass market bank. They want to bring their unsecured lending to less than 60% by 3 years. Ujjivan Small Finance Bank is expected to complete the reverse merger with its holding company, Ujjivan Financial Services Limited, in 3 to 4 months from now, provided they get all the approvals. The merger was announced in October 14, 2022. So the NCLT, National Company Law Tribunal, is set to conduct a hearing on January 30, 2024 regarding the approval of the reverse merger between Ujjivan Small Finance Bank and Ujjivan Financial Services Limited. Axis Securities has found some advantages for investors of parent company Ujjivan Financial Services. They have recommended that investors buy Ujjivan Financial Services to capture arbitrage opportunity for Ujjivan Small Finance Bank. I will explain the take of Axis Securities. One share of Ujjivan Financial Services Limited cost around 592 rupees and one share of Ujjivan Small Finance Bank cost around 58.75 rupees. For every 10 share of Ujjivan Financial Services, 116 shares of Ujjivan Small Finance Bank will be provided. 10 shares of Ujjivan Financial Services cost rupees 5,920 and 116 shares of Ujjivan Small Finance Bank cost rupees 6,815. By buying 5,920 worth shares of Ujjivan Financial Services, the investor will get Ujjivan Small Finance Bank shares worth rupees 6,815. This is an arbitrage opportunity found by Axis Securities for this stock. Threats. The Reserve Bank of India observed some issues in working of small finance bank. First one is that many small finance banks have low current account and saving account deposits. They rely on bulk term deposits acquired at higher rates, especially from cooperative banks. So there is a high degree of interconnectedness of small finance bank with cooperative banks. Any shock in the cooperative bank sector will spill over to these small finance banks. Secondly, RBI cautioned that as small finance banks were converted from microfinance institutions, they continue to have a higher share of micro loans which are unsecured in nature. This lack of asset diversification along with geographical concentration creates significant concentration risk. The consolidated balance sheet of small finance bank grew at a faster pace than that of scheduled commercial banks during 2022-2023. RBI observed that with deposit growth slowing down during the year, a small finance bank have to resort to higher borrowings to fuel credit growth. So we are reaching the end of this analysis. Even though I was little apprehensive initially about small finance banks, upon analysis I have found small finance banks are a good investment opportunity. As per my working, Ujjivan Small Finance Bank is emerging as the best opportunity, even though Utkarsh Small Finance Bank is also very good. I hope you have got some insights on how to analyze this sector. While I was about to publish this video, Q3 financial year 24 results of Ujjivan Small Finance Bank got released. Most of the parameters are in the same range. Net NPA has slightly increased from 0.09% in Q2 to 0.16% in Q3. Capital adequacy ratio has slightly reduced from 25.2% in Q2 to 24.4% in Q3. In addition, there is a reduction in return on asset and return on equity. Return on asset has reduced from 3.6 to 3.1, and return on equity has also slightly reduced from 28 to 24.2%. But these reductions are very marginal, and I don't think that there is any impact on the future performance. The good aspect after the result is that the price of Ujjivan Small Finance Bank got corrected almost 7-8%, and it again presented a good opportunity to buy this stock and accumulate. I have made the video to share my thoughts about this sector, and this is only for informational and educational purposes. I am doing this analysis as a hobby. I think it would benefit you if you are subscribing to my channel, as I strive to create good content.